All right, morning everyone. Welcome to Compound Interesting. This is Emil, and in today's video, we have a special edition, special newbie edition. And the reason I'm making this video is because I see a lot of noobs getting involved in the stock market and getting interested in the stock market. So I wanted to lay down some of my tips for absolute beginners in the stock market and how absolute beginners can make money in the stock market. Well, not straight away, but over time. So from the title of this video, you can tell that this is for easy money. And what I mean by making easy money in the stock market means that it doesn't require a huge amount of effort. It doesn't require to be extraordinarily skilled. So this is just for noobs. But the caveat that comes with easier money, it's not like super easy, but the caveat is that because it's easier, the potential reward isn't as high. But over a long period of time, you can still make a fortune and enough to retire on. So that's the kind of investing we're going to be discussing today. So it's kind of geared towards someone who's not really interested in the stock market that much, but just wants to take advantage and start saving money for their retirement or making a little extra passive income. That's the focus of today's video. So if you're a more experienced investor, I'm going to lay down some good investing principles, so you might want to stick around, but probably it's a lot of stuff that you already know. So this is mostly for the newbie investor. So if you're a noob, buckle up. All right, so these are the tips that I would give to my sister or to my friend who's just starting out and someone who might not be super like interested in picking individual stocks and researching companies and really digging through annual reports, etc. It's just someone who wants to, make a little bit of extra money, or it's someone who's just being financially smart by saving a little bit and trying to compound their money over time. So the first tip I would give is to invest most of your money in an index fund. So if you don't know what an index fund is essentially just a basket of stocks. So the most famous index fund is the S&P 500, which tracks the 500 biggest stocks in the stock market and just buys a proportional weight of each of those stocks in the stock market. So over a long period of time, the S&P 500 does extraordinarily well in comparisons to keeping your money under the mattress.
Wow! Oh my God!
So the advantage of using an index fund is if one of the companies in the S&P 500 goes bankrupt or it drops 50%, you'd probably barely even notice. However, there will still be drops in index funds as the economy comes and goes. The S&P dropped 30% during the coronavirus crash. But there's much less risk than picking individual stocks, which I see a lot of noobs trying to do right now, and they don't really know what they're doing. They're not really researching companies, and they're just buying random stocks that people on YouTube are telling them to buy. And maybe some of you who are just new are picking stocks that I'm buying and without actually really researching it, because that's the exact same thing that I did when I started out. I just bought stocks that anyone was telling me was a good buy without really researching it. So if you don't know how to research a company, I'll leave a link up there. And if you want to know my favorite index fund, I'll also leave a link up there to another video. But if you're a real newbie in the stock market, don't try and pick individual stocks straight away. Just start out in the index funds. And the next tip I would give you, which is also extremely important, is dollar cost averaging. So what's dollar cost averaging? Dollar cost averaging is saying I have, let's say, $500 or €500 disposable income every month that I have to invest in the stock market, or I have an extra €100 or whatever amount that you feel you want to invest per month into the stock market or per week. You just say, okay, this is the amount I'm going to invest into the stock market. This is how much I want to put into index fund every single week or every single month, the exact same amount in dollar value every single month or every single week forever. So this avoids you getting greedy and buying more and more as the market's going up and getting scared and buying less and less if the market's going down. If you have a set amount that you're going to put in every single month and you are very disciplined, that is, along with index fund investing, creates phenomenal returns over the long run. So let me just show you quickly an average return for the S&P 500, the average return that has produced over the last 100 years. All right, so this is a hypothetical situation. This is the 8% is the annual average return over a long period of time of the S&P 500. So that's the average return of the stock market if you're buying every single stock in the stock market or the top 500 stocks. It's about 10% a year, which actually makes a big difference in the long run. but we're going to be conservative and say 8%. All right, and we're going to assume that you can put away $500 a month. Now, that's completely up to you. You have to go into a compound interest calculator website and put in your own figures. But this is just to show you the power of compounding. So let's say you have $1,000 just sitting in your bank account. You're just going to throw that in, and then from now on, $500 out of your paycheck every month is going to go into the stock market buying index funds. So let's see what the returns are like. So after 10 years, you put in $61,000 in total with $33,000 in interest. Now, let me say that you're not going to get 8% every single year. Some years it'll be 30%, really, really good. Some years it'll be minus 10%, minus 20%. Some years it'll be 5%, etc., etc. But averaged out, it'll be 8%. And because you're dollar cost averaging, you're getting the average price of the stock market. So because you're dollar cost averaging, you don't have to worry about trying to buy at the very perfect time, because even if you buy at the very peak of just before a recession, you're still going to be buying all the way down. So you're still going to get the average price. So that's why dollar cost averaging, another reason why it's so powerful. So after 10 years, yeah, you've earned 33,000 in interest. Yeah, not that amazing, but nice. Then we look down to 20 years. You've put in 120 grand into the stock market and you've earned 180,000 in interest. So you have a 300,000 total. So yeah, starting to get pretty good. So this is for long-term investors, you see. So 20 years, maybe you don't have that long in the stock market. But if you're a noob, hopefully you have a long way before you're retiring. I'm only 24, almost 25. So I have at least 40 years until I retire in the normal standard. Now we'll move on to 30 years. You've put in 181,000 in total into the stock market and you've earned over $500,000 in interest, and now you have $750,000 sitting in your stock market account. So almost enough to retire when I would be 55. Well, let's see, when I'm 65, 40 years, I've put in 240,000 into the stock market in total, and I've earned $1.5 million in interest. So I'll have 1.8 million sitting in my stock market portfolio. So you can see the advantage of time. So that's another principle that is obviously really powerful, is how long you have to invest. So the best time to plant a tree was 20 years ago. And just like with investing, the best time to start investing was 20 years ago. But if you can't invest 20 years ago, if you don't have a time machine, start right now. Start small, investing into the S&P 500 or any of those index funds that I mentioned in that other video, and let your money start to compound and work for you straight away. And now start small, because you have to learn to be able to deal with the fluctuations, because it's going to go up, it's going to go down, it's going to go up, it's going to go down. But you have to be extremely strict with your dollar cost averaging. Otherwise, it won't work as well. Because if you let your emotions rule your decisions, even if you think the stock market's way overpriced, just like when I'll leave a video link to when I thought the market was way overpriced and everyone thought the market was way overpriced like 2 months ago when we started getting that nice correction from the coronavirus crash. Everyone was saying, oh, we have to get a double recession, or it's going to go back down. And I was like, okay, I think it's more likely that the coronavirus, or I think it's more likely that the stock market's going to drop again. We at this stage, we'd have recovered like 20% or something. I thought it was more likely that the stock market would go down, but I stuck to my strategy, and I had been buying all the way up to the corona crash, all the way down during the corona crash, and I've been buying all the way back up the corona crash. And luckily I didn't stop buying, even though I thought that there was going to be another crash. I kept on buying, and it worked out well for me now, because since then we got another 20% growth in the S&P 500 and all the other index funds. But in my individual stocks have done extraordinarily well since then. Yeah, for this video, we're not talking about individual stocks so much. I'll probably be releasing a follow-up video on how to make an enormous amount of money in the stock market rather than just easy money. So an enormous amount of money in the stock market requires hard work rather than just like easy money, you know what I mean? So if you're not a subscriber, subscribe so you'll see that video. And if you could, maybe just like the video as well. That would mean the world to me. Thank you. All right, let's fly through another few of these principles. All right, so the next principle is to never sell your stocks and never sell your index funds. Now, for the individual, if you're a complete beginner, I want you to have like at least 70-80% in index funds, and maybe you can play around with some stocks to get used to it if you are the type of person who you think will become interested in investing in individual companies over time, and you can gradually start. If you're just starting out, you can even use play money, because a lot of brokerages offer that. Trading 212 offers the chance for you to just play around with play money. So start investing with play money if you want, but I am assuming most of you will want to start investing with real money to start getting those compounding effects. So maybe just start out small. So I'll just say I'm going to put in €100 a week into index funds, but even though you think in 3 months time I'm going to be putting €200 a week, because that's how much I could actually afford to put in. But just start out small so you get used to the fluctuations. There's going to be huge crashes. At some point in your life, you're going to lose an enormous amount of money. And at some point in your life, you're going to make an enormous amount of money. You have to remember that unless you sell those stocks or those index funds, those enormous amounts of money that you make or that you lose, you haven't actually realized those profits or those losses until you sell. And I would strongly advise against selling any of your index funds unless you actually need the money. So most people sell at the very, very worst time. So in the stock market and in individual stock picking, it's extremely, almost impossible to buy at the perfect price, but it's also hard to buy at a good price, but it's possible to buy at a good price. However, it's even way harder to sell at a good price and almost impossible to sell at the perfect price. Because the stock market generally trends up and stocks generally trend up, that means selling, you're more likely to lose out on potential returns if you sell early, or because it's so hard to predict what's going to happen in the stock market. And if you're a noob, you definitely won't be able to pick the right time to sell. So don't even try and sell index funds, even if there will always be some sort of warning or news or something that would make you scared about your stocks and make you think that all your stocks are going to go to zero. You have to ignore your emotions, ignore that kind of knee-jerk reaction or that emotional reaction. You have to use your logical brain, calm down, and just be patient and disciplined. Buy the same amount every single month or every single week, and buy safe index funds and some safe companies if you're a noob. You're not an economist, so don't try and predict what's going to happen in the economy, because that's like trying to predict the weather. It's basically impossible. Another piece of advice that I would give to an absolute noob in the stock market is to never ever make short-term predictions about the economy or about an individual stock or about any sort of index fund. Never make short-term predictions. So don't try and buy and sell within even a year. If you're a noob in the stock market, the best you can hope for is to buy an index fund down here and then sell in like 10 years time when the index fund has doubled or tripled, hopefully. But even for the most experienced traders and investors in the world, they very rarely make good short-term predictions consistently. So the chances of you being able to make a short-term prediction are pretty close to nil. So don't try and do short-term plays, or if you think a company's going to go really high tomorrow because blah blah blah, some thing that's coming out. No, just don't even try with that kind of crap. Just buy dollar cost average into good solid companies for the very, very long term, especially if you're a noob. I would also add to that point, if you're a noob, don't try and play around with options. Don't try and play around with shorting a stock. Don't try and play around with CFDs or any of that crap. Literally just buy companies or buy index funds and hold them for the long term. And if you don't know what any of those terms mean, you don't need to know. Don't worry about that stuff. Just do the easy buying and dollar cost averaging your way into the stock market and get that gradual 8% annual return, because that will make you a fortune if you have enough patience. All right, so if you enjoyed that video, you probably will enjoy the one I'm going to link at the end of this video and up there. And that's some more investing secrets and more investing hacks that will make you a lot of money in the stock market, because it's quite similar to this, but probably more information tied to less of a newbie audience. So I really hope you enjoyed the video. Please smash the thumbs up button. Sorry the video quality wasn't so good today. I've had to record it on my phone, but we all make do, and I wanted to bring you this Hopefully very useful video, and because I'm so worried about a lot of people getting involved in the stock market when they don't really know what they're doing, so I just want them to go for these safer options, especially if they're new. So with all that said, make sure to subscribe, hit the notification bell, and I can't wait to see you in the next video. Thank you so much for watching.